Right, so check this. My new algo just spit out a 300% backtest on Solana.
Yeah?
Simple MA crossover.
Okay.
Last 18 months. Clean. Tell me I'm not a genius, Morgan. Go on.
Scoff. Mate, 300% in a crypto bull run?
Yeah?
My nan could have tripped over her keyboard and made 300%. That's not a model, bruv. That's a lottery ticket that happened to hit.
Oi.
You just stowed in a hurricane and are bragging about catching a breeze.
Allow it. Numbers are numbers. The P&L curve is looking pang. What's the problem?
The problem is, right, you've only tested it in one market regime.
Right.
It's like saying your new motor is fast, but you've only ever driven it downhill with a gale force wind pushing you. What happens when you hit a hill or a traffic jam?
Dismissive. Regimes. Don't come at me with your boring TradFi textbook words. Is that some dusty Forex term for when the chart goes down?
Nah, it's a not losing all your money term. It's dead simple. The market has moods, right? You've got the bull regime, where everyone's gassed and printing money.
Right.
That's your Solana backtest.
The best regime then.
Sure. But then you've got the bear regime, the bloodbath, Bitcoin in 2022. And then you have my personal hell, the sideways chop.
Ugh.
The market goes absolutely nowhere, just bleeding you dry with fake outs and tiny little cuts. A proper model has to survive all three. Your model's just a fair weather sailor.
Fine. So I'll test it on the 2022 data. Problem solved.
That's step one, but you're still missing the main point. This is proper CMT level 3 thinking. Just testing on a big chunk of the past is called curve fitting.
Okay.
You've basically designed a strategy that was perfect for a world that doesn't exist anymore.
Curve fitting? Explain it to me like I trade meme coins. Perfect.
Right. Imagine you create a perfect key that opens a specific lock. You're gassed, but that lock was from your 2023 front door. In 2025, the landlord changes the lock.
Uh-huh.
Is your perfect key any good? Nah, it's useless. You got over-optimized for the past. That's what your backtest is.
All right. I feel personally attacked. So, Professor Morgan, how do we validate it properly so my key opens the new door too?
First, you use walk-forward optimization.
Okay.
It's smarter than a simple backtest.
Got it.
A basic backtest might use, say, 2015 to 2022 to train the model, find the best settings, and then test it on 2023 to 2025.
Right.
They call that the out-of-sample period.
I know what that is, mate. I'm not a complete degen.
Yeah, but here's the clever part with walk forward.
Yeah.
You train on a smaller, more recent window. So you train on 2015, 2016 to find your settings, and you test only on 2017. You write down the results.
Okay.
Then you roll it forward.
Right.
Your next test uses 2016, 2017 to optimize. You test it on 2018. Then train on 2017, 2018, and test on 2019. You keep walking forward through time,
Okay.
stitching all those out-of-sample years together.
Aha, I see. So you're creating one long performance history that was always tested on unseen data.
Exactly. It simulates how you'd actually trade in real life, constantly adapting. This proves if your strategy can adapt across different regimes. If the performance holds up across all those walks, you might actually have something.
That sounds incredibly long. A lot more effort than just hitting run, mate.
Do you want to be rich or do you want it to be easy? Pick one. The work is the edge. If it was easy, everyone would do it.
Okay. Walk forward testing. I get it. It's like a proper MOT for your strategy. Interesting. What else you got in your box of boomer tricks?
All right, another one for you. Parameter sensitivity. Your MA crossover, what are the periods?
21 and 55.
Fibonacci in it? Classic. Okay, but what happens to your 300% return if you change them to 22 and 56? Or 20 and 54?
I don't know. I haven't checked. It'd be probably a bit worse.
A bit worse is fine. But what if it completely falls off a cliff? What if it goes from 300% profit to a 50% loss?
Yeah.
If a tiny nudge to your settings nukes your performance?
Yeah.
That's a massive red flag. It means you haven't found a real market dynamic. You just found the one magical combination of numbers that worked perfectly on that specific data set.
So it's another form of curve fitting.
The worst kind. It's brittle. A robust model has a neighborhood of good parameters.
Okay.
It should still work reasonably well with slightly different settings because it's captured a real underlying market behavior, not just noise.
So I need to test the whole area around my perfect settings to make sure I'm not on a tiny little island of profit surrounded by a sea of losses.
You're a poet, mate. And one last thing, and this is crucial for surviving. You need to look beyond the final P&L number. What about the ride?
What do you mean?
I'm talking about your risk metrics, your maximum drawdown.
The biggest drop from a peak.
Yeah, your 300% backtest is lovely, but what if at halfway through, it had a 70% drawdown?
Oh.
Could your account survive that? More importantly, could you psychologically survive that? Would you have the bottle to stick to the plan while your account's getting cut in half and then some?
Probably not. I'd be panic selling and tweeting about how crypto is a scam.
Exactly. So a model is useless if its drawdown is bigger than your emotional breaking point. Then you've got your Sharpe ratio.
Right. I've heard of that. Return over risk or something?
Basically, yeah. It's how much bang you're getting for the buck of volatility you're enduring.
Okay.
A high Sharpe ratio means you're getting smooth, consistent returns. A low one means you're on a violent roller coaster for mediocre gains. You want a model with a Sharpe ratio above 1, ideally higher.
Okay, so to summarize for the apes in the back.
Go on.
1, a simple backtest is fool's gold. I need to test my model across the market's different moods, bull, bear, and the sideways garbage.
Yep.
2, I use walk-forward tests to make sure the strategy adapts like a real trader and isn't just a fluke of the past.
Correct.
3, I throw it into the Monte Carlo chaos machine to check for path dependency and make sure my genius wasn't just pure dumb luck with the trade sequence.
Keep going.
4, I check the parameters sensitivity. I need to jiggle my settings around to make sure the model is robust and not brittle.
You're on fire.
And 5, I look at the max drawdown and the Sharpe ratio to make sure the strategy's personality is one I can actually live with and trade in the real world without having a mental breakdown.
Clap slowly, impressed. He gets it. That's the path. That's how you build a system that can actually weather a storm, not just a model that looks good in a spreadsheet.
I'm still backing my simple crossover, but I admit you've given me some homework. It's just peak that doing things properly is so much work.
Mate, if building a money printing machine was easy, we'd all be doing it from a yacht. The work is the edge.
Fair play, you old soul. All right, everyone listening, if you want to roast Morgan's dusty TradFi theories or tell me my crypto model is the future, you know what to do.
Yep,
The link to our private chat group is down below. Before you jump in, do us a favor and sign up with our CX ref link to say thanks. It helps us keep the lights on.
Every little helps.
And the server's running for these backtests.
Then hop in and have a laugh with us. Now, here's a question we'd like you to think about. Ooh, yeah, good one.
When you look at your own trading strategy, are you honestly testing it to find its flaws? Or are you just looking for evidence to confirm you've found a golden ticket?
Be honest with yourself. Deep. We'll see you in the chat.